Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so our market has managed to rise a little bit today, despite the big pullback we saw yesterday. Now, we'll talk a bit more about why we fell so much yesterday in a moment, but just to the technicals right now, you can see we're holding this overall uptrend line, and the key level of support here through 69.52. All right, so that's key at the moment, guys. All right, if that clears through, targets of about 68 or 66. Personally, I'm feeling more like we're going to head back down towards 66 by the end of September, where we've got the next Fed meeting and a few CPI readings between now and then. So I suspect a bit more of a bearish month will come for us in September. This time of year usually is a little bit more bearish after the reporting season, so I wouldn't be surprised to see that sort of bit more of a pullback through here. Technicals though aren't quite lining up to that just yet. We'll see what the next few days brings. But when I jump across to the S&P 500 and talk a little bit about the reasons why we fell yesterday, you might sort of understand why I'm a little bit more bearish still. So looking at the S&P 500, you can see here a clear breakdown of trend. Okay, so that's now come and gone. If I pull this support level down just a touch, you can see a head and shoulders pattern here that broke through yesterday. But what we found ourselves in right now is a bit of an oversold condition. So I think a few days up here is likely. I think we'll stick inside this downward channel up until we get to a point where we fulfill that head and shoulders pattern. And that gives me targets to around 39. If things want to get real ugly, we'll head back down to the yearly lows around 37. So technicals on the S&P 500 to me look a bit more bearish medium term, although short term we're getting a little bit in that oversold condition. So a couple of days of buying, I wouldn't be surprised to see. But all in all, I think once again we're sort of a bit more bearish for September, or lining up for a bearish September unless something changes the mood. All right, so what happened? Well, Friday we saw, US markets fall, 3.5%. That was after Jay Powell's comments at Jackson's Hole. Basically, he remained a lot more hawkish than what most people were expecting. Okay, so we saw, coming into that announcement, we had bond markets and the actual official Fed cash rates getting very close to each other. What we're seeing now is a bit of a change to that after the last round of comments from Jay Powell. A lot of expecting rates to go up a fair bit more and stay higher for longer. So what exactly did he say? Well, he was basically saying that the battle to bring inflation down will continue and likely go longer than what many are expecting. It's going to require a lot of basically demand destruction, and households and a lot of companies are going to have to suffer before inflation is going to come back down. So they're going to go to a more restrictive stance. Okay, they're neutral currently. That's going to go to a more restrictive stance up until a time where we start seeing inflation fall. Now, depending on your view on inflation, will, I guess, which will dictate whether you want to be a buyer in this market or not. I'm probably on the side of inflation is going to stay high for a lot longer than what people think. I think energy prices are going to jump again. I think crude is going to get it back above 100. And this whole supply chain issue is going to take a bit longer to fix itself. Okay, so I really do think inflation's here to stay for another 12 months or so, where a lot of other people are thinking it's going to come down rather quickly. Well, only time's going to tell, but at this stage, I'm going to trade and invest on what's in front of me. And what's in front of me right now is that the central banks are still on a rate hiking cycle, gone from near zero interest rates for many countries, heading up towards 3 to 4% in a very short period of time. That will weaken economies, and that data will take some time to flow through and really become reality. So I'm still a bit more bearish for the rest of the year, guys. And when I say bearish, I kind of still feel like maybe we'll just go down and retest the current lows. I think the market's been pretty efficient in pricing most of this in, but I can't see us going into this or maintaining this upward momentum we've seen recently. We've got, I think it's going to be more sideways for the rest of the year. So Fed rates are now, or bond markets are now pricing that the Fed's going to go to 4% by early next year and hold up there for a period of time. That's a far contrast to where markets were pricing before the Fed meeting, and that was that rates were only going to go up to around 3% and fall early next year. So equity markets need to reprice, I feel, at this point of time, and we'll see a bit more downward movement through September as we come closer into that next Fed meeting. The next test for CPI really is going to be Wednesday night out of Europe. Okay, let's see how that comes in. If it comes in a little bit higher, I suspect that markets will continue their sell-off from Friday. So will markets keep falling? It's going to depend on a few things, okay? One's going to be bond markets and whether bond markets keep selling off, which means yields keep shooting higher. If we see that continue to happen in the coming months, that means many people are believing inflation's out of control and that interest rates will have to keep going higher and higher and higher to bring that inflation down. That's going to be negative, especially for growth stocks. So US markets are going to get hit harder than our market will get hit, although most sectors will probably fall. Energy is remaining resilient, and that's more based on crude prices and energy prices in general. Rather, the rest of the market wants energy down, and the energy sector wants crude and that up, right? So energy is going to remain that bullish sector if the market continues to fall. So will markets keep falling? It's going to come down to whether inflation can start coming down, if it continues to hold high, okay, or rise. I think markets will keep falling. And that's what it's really going to come down to, because you're just going to continue to see the Fed and other central banks front load. Okay, so I'll become a lot more bullish once I know inflation's easing off. And it seemed like that was going to happen until we heard talks from OPEC about cutting production. And if OPEC members start cutting production, and we'll find out on Monday when they meet next. So there's talks that Saudis want to cut production. There's a lot of geopolitical things happening amongst that. So without going into too much detail, I'll be here for another 20 minutes. Basically, come Monday, guys, if OPEC do decide to actually cut production, crude will come back up. And what ramification has that got for inflation? Well, it means inflation is going to remain higher for longer. It means interest rates will have to go up further and stay higher for longer. It means the economies will be weakening further, and potential recessions. So to me, that's all very, very negative right now. So I'm struggling to see the positivity right now, guys, okay? The outlook to me is a restrictive outlook. When we came out of COVID, it was all stimulus, helicopter money, and that made us extremely bullish. Economies wanted to spend big to recover. Well, at the moment, I think things are moving the other way. People, the central banks are actually trying to destroy demand. They're trying to slow economies down. That's not good long term, right, or medium term. So we need to know, where's that shift? When are they going to shift back to coming out of restrictive mode into accommodative mode? And that's I think that's what the market was running up on recently. Was that I think the view was most people believed that was going to happen early next year. That's pushed out further, guys. And the further it keeps pushing out, the more damage that's going to be done, and the worse this recession is going to end up being. Now, understand that the US is in a sort of two quarters of negative GDP. That in any other country is classified as a recession. They're not classifying it as a recession because the employment's so strong, but that could turn, guys. That could really turn if interest rates keep going up and stay high. So look, there's a lot of risks on the table is all I'm saying. I think that the actual equity market's priced most of this in, but don't be surprised if markets go back down to recent lows or this year's low. Okay, so I'm talking 64 for the XJO, talking about 3,600 for the S&P. If it gets back down there, we'll evaluate again. But I think we'll see that in the next few months quite easily. And we'll just be watching for things like the CPI reading, this OPEC meeting. Anything that's related to interest rates and inflation is going to be key here. So watch out for any of that data because that's what's going to move markets one way or the other, guys. Okay. Really, there's not much else to say. As I said, the S&P 500 is looking a bit bearish for me in the short term over the next month. I think that's going to drag most other equity markets down with it, and yeah, we just sort of take it from there, guys. Okay, so just be careful going long or buying the dip right here. If that CPI reading is a bit higher than expected tomorrow night out of Europe, I suspect markets will fall in a volatile manner again. Tonight, I think the equity market, the US market could be up just a little bit because it is a bit oversold. But yeah, I think later in the week we'll start seeing some selling come back in. All right, not much else for me to say here. Thanks for listening in. Take care and bye for now.